Good afternoon, everyone. It is a pleasure for us to be here today. Allow me to introduce ourselves. My name is Eddie Chavez, and together with my partners Nayeli Benitez, Maricelo Guaman, and Luis Alenas, we form the group responsible for deploying this topic. The topic we will be presentation is titled Analysis of the International Accounting Standards. A IAS 1, IAS 2, IAS 8, IAS 16, which we consider highly important for the professional accounting practice and the proper presentation of financial information.
IAS-1 sets out the basic guidelines for the different and purpose of final reports, including the format, minimum required content, and general rules to be observed such as considered current and accurate representation according to Obando 2020 Day purpose for the standard is the established they former to the preference of the for final is stimulated to a survey our components.
Similarly, IAF is too adopted by the Minister of Economy and Finance 2020 establishes principles for inventory accounts, valuation and presentation in financial statements. The standard aims to ensure that inventory is recorded at the lower of cost or net realizable value, facilitating a representation of the recourse available for ease in production of cell. This standard is highly important for organizations across from the private and public sectors as it directly impacts gross profit, gross sale, and operational efficiency indicators.
According to Bonilla 2020, the object study EIS A to a standard is connection in an organization filing stand, revealed the normative shortcoming with the entity.
In this context, it is essential to highlight the role of IAS 16, which regulates the accounting treatment of fixed assets such as buildings, machinery, furniture, and other tangible goods used by an entity. According to Rodriguez Saavedra 2024, this standard establishes key principles for this clear recording, measurement, and presentation of these assets. Considering aspects such as acquisitions cost, estimated useful life, accumulated depreciations, and in some case the revaluations of asset value.
IAS-1 a presentation of finalized statement definition. AS1 a response for establishing the former for representation of finalized reports. IMER in 8 preventing honor for information insert to score convert board with errand private report ends where they of their organization.
The standard is applied in all organizations that have inventories within their structure except in specific cases. It does not apply to broad farm forestry or agricultural activities, mineral processing extraction, since their accounts is governed by other standards, nor agricultural products after harvest. Certain types of product sector inventories of financial instruments. IASB 2023 Initial Measurement, Subsequent Measurement, Costing Methods, Excepting Recording. Initial measurements. Inventory must be initially recorded at cost. The included the purchase price of the goods, transformation costs, and any additional costs necessary to read the inventories to their perform location and condition for sale or use. Subsequent measurement. After initial recording, inventories are measured at the lower of cost or net realizable value, which represent the estimated selling price less all cost of completion and sellings. Costing methods. The standard allows for methods such as FIFO, meaning the first is purchased are the first to be sold. Expense recording. The cost of inventory is recorded as an expense in the period in which the inventory are sold or set a business operation.
IAS accounting policy changes in accounting estimation and errors. IAS is a place searching different interpretations. Accounting policies are understood and specified for the preparation of companies' financial statements. Changes in accounting estimation are treated as revisions due to upward values. Errors are consideration and omissions of inaccuracies in financial report resulting for the mismanagement of accounting data. Application. Accounting policy. These are the principles and procedures the entity adopts to record and present its transaction. If an entity changes an accounting policy, it must IP the accounting retrospectively meaning in mass result. Priori financing statements of is the new policy have always been in a base. Chances in accounting estimation. This is occur when new information of developments cause a revision of priori estimation. Unlike accounting policy, chances in estimation are applied prospectively from the date of the chance onward. Correction of errors. When a material error from a priori period is identified, it must be corrected retrospectively, enhancing the opening balance of equity and restoring comparative financial statements accordingly.
IAS 16. Property, plant, and equipment. Definition is responsible for regulation the accounting treatment of tangible assets held by an organization for use in the production of goods and or service for administrative purposes or for leasing. These assets are expected to be used over more than one accounting period. Application. In accounting practice, the application of this standard involves recognizing fixed asset only when it is probable that the asset will generate future economic benefits for the entity, and when its cost can be readily measured. After initial recognizing clear depreciation, policy must be applied to allocate the asset's costs over its useful life. Example, a company acquires industrial machinery for 100,000. The equipment has an estimated useful life of 10 years old and an estimate residual value of 10,000. Under IAS 16, the accountant must recognize the asset on the statement of financial positions at its acquisition cost, apply a depreciation method, and record an annual depreciation expense of 9,000. If over time the market shows that this type of machinery has um, increased in value and meets key criteria for evaluation, that carrying amount can be adjusted to reflect this change, provided it is done objectively and with proper technical support.